Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
It's April. ISA season is here. But what should you buy? Should you stick with a classic index fund? Or is there a case for doing something different this year? And if you're tempted to have a little fun with your investments, how much is too much?
We break down the options for your core portfolio and your fund money. And in today's dumb question of the week, what's the point of a fund portfolio if it's not going to beat the market? All right, let's get into it. So I think we'll split this episode into two parts, Roman. Firstly, we'll talk about the core portfolio, the boring stuff. And then the second half, maybe the fund portfolio and things you might want to use to throw away the gains you make with your core.
I wish that wasn't true.
But in terms of our core investments, I know you like to keep it simple. One fund, you always say. Are you going to say what you always say? Buy a low-fee, globally diversified, market cap-weighted index fund and hold it for the long term?
Yes, I think I am going to say that. But look, that's the point of the core, isn't it? It's supposed to be there and simple, and you don't fiddle around with it. Despite what happens in the news, despite what happens in the economy, its function is to be the core, and the core doesn't change.
But isn't it a bit like we're going to this wonderful restaurant? We're sitting down, looking at the menu. There's all these options. Everything sounds so delicious. And you're saying, every year, just buy the chicken salad. It's healthy. It's good for you. Come on, put some Parmesan on it this year at least.
Well, in America, they used to call it the fixings, didn't they? The stuff that went with it. So this is like having a really healthy main dish, but you can have anything you want in the entrees, the amuse-bouche, and for the puddings. You just don't have too much of them.
Okay, but I think people this year are looking at their main course, their chicken salad, and they're thinking, well, maybe there's a case this year to season it a little differently. Should I have a currency hedge in place? We've seen that the dollar is weakening, which from a UK investor point of view is not helping our investments. They're falling in value more than they would have.
Yeah, and that's really unusual. Usually having a sterling-based approach to global investing has helped because sterling sells off when people are scared, and that boosts your US holdings, and you don't sell off as much as, say, a US investor would. Well, everything's reversed this year because you've got the double whammy of a weakening dollar combined with weakening US stocks. So really, from our point of view, it's been a pretty awful year. The chicken's off.
But I was thinking about this, Roman, and I wonder if that's seeing it in the wrong way. Because we always say that if you're early in your investing journey, in the accumulation phase, you should kind of welcome a stock market fall because you're buying things at a discount, which is going to boost your long-term returns. You kind of like it if stocks are cheaper. And if the dollar's weakening, stocks are just getting even cheaper for you, especially if you don't believe that this currency change is going to be long-term.
Yeah, I agree. I think if you're in the accumulation phase, then this is making stocks much cheaper. This huge macroeconomic shock is not going to last forever. So what it's really doing is making a cheaper entry point. And we'll talk about this when we talk about the fund portfolio. It's making a cheaper entry point for things that were really expensive. And of course, global index funds were really expensive because they were primarily US dollar-based US stocks.
But what do you think then about currency hedging? The dollar is weakening. If we think that's going to continue, then it would make sense to buy a currency hedged index fund, wouldn't it?
Assuming that the dollar sell-off is going to continue, yeah. And I think that's the problem. I think that the US has a fairly good self-correcting mechanism, which is business. Business, if it starts to hurt, will push back on whatever it is that's reducing valuations, whether it's politics, whether it's some kind of trade deal, whether it's to do with energy stability and energy independence, whatever it is, US business usually finds the solution.
But on the specifics of the dollar, US business might not hate a weaker dollar, especially if they're exporters. It's going to flatter their results. They'll hate everything else that's going on in policy around tariffs, but on the specifics of the dollar, they might not care.
Yeah, that's true if they're exporters. But remember that a lot of US businesses are US based and they have to pay for things to come into the country. So these tariffs are what's really hurting them. And many of them aren't exporters, certainly for the small caps and mid caps. So I think while it's true that large businesses will want a weaker US dollar, it's not true for the mid caps and small caps, which are largely domestic.
And from our point of view as investors, if we're choosing whether to currency hedge or not, typically we've said with equity funds, it doesn't make a lot of sense because over the long term, the drift upwards of stock prices will overwhelm the relatively small moves in currency markets. So how do you see currency hedging? Is there just no case for it? Or if you have a very strong view on what's going to happen to currency, would it make sense? Are you just placing a bet basically on where you think exchange rates will go?
Yeah, I think with currency, I'd be amazed if the US dollar versus its trade-weighted partners is in a massively different place from here in 5 years' time or 10 years' time. That would be surprising, very surprising to me. Because eventually things are going to self-correct. I think eventually things are going to improve. Trade policies will improve. Trump won't be president. And things will heal. Because primarily what drives currency is things like growth differentials and things like trade policy. But primarily it's to do with interest rate differentials. And I'd be amazed if those were hugely different in 5 years' time or 10 years' time from where they are today. At the moment, we're pricing in something which is very, very, very unusual for the US dollar, which is a risk premium. That's something I've never seen before. Some people call it a moron risk premium. But I think eventually the moron will fade and we'll get back to where we were.
But people don't like to lose money in the short term, and that's why people think about currency hedging. One thing I've wondered about is what is the kind of neutral position here? You see a lot of debate online. Like some people would say the neutral position is to be perfectly currency hedged with all your investments, because then you're just taking FX moves off the table, you're getting the pure return of the stock market. Whereas other people say, like you do, in the long term, doesn't make a lot of difference. You may as well just go for the lower fee, don't currency hedge. Whereas some people say the neutral position is to currency hedge 50% of your investments, and therefore you're kind of not taking a directional bet on interest rates as you were.
I think what people forget is, firstly, that there is a cost for the hedge. There will be some kind of currency overlay or derivative, which ultimately you'll be paying for. What isn't shown in that expense ratio is a long-term drift element, which is based on your interest rates, short-term interest rates, versus those in the US. Now, if you're European-based, typically the Eurozone has had a lower interest rate than in the US. So this would have been a huge drag, that interest rate differential, from the currency swap for your overall returns over a very long period of time, about a decade.
Yeah, if you plot the graph of a currency hedged ETF for a sterling investor or a euro investor versus the non-hedged version, yeah, you'd have been paying a huge cost for hedging.
It's not so bad in sterling because usually our short-term rates more closely match the US. But certainly for a European investor, it would have been a pretty awful outcome.
I mean, it's been pretty bad for a sterling investor just because the pound has weakened over the last decade, relatively speaking.
Yeah, that's right. And it was a huge benefit to us.
But now people are thinking, well, maybe if that goes into reverse and mean reverts a bit, I don't want to be caught on the wrong side of the mean regression.
Yeah, I just remember how large equity returns are relative to currency. If you look over a very long period, say 30 years, which is most people's investment period, then you could effectively ignore currency movements. But like you say, over the last, 100 years or so, sterling has been weakening versus the dollar. So if you go back to the Bretton Woods Agreement, when it was pegged to the dollar, it was pegged at $4.03 per pound.
Oh, US holidays would have been so cheap back then, except for the fact you've got to get on a boat or something. I don't know.
On a steamer, yeah.
Yeah. All right, so I'm sensing that you're not a big fan of currency hedging equity funds. But maybe there are other accoutrements you want to add to your chicken salad here. Some people are saying, yeah, market cap weighting has worked really well in the past, but now we've seen such concentration in global index funds, largely in those magnificent 7 stocks. Maybe now we don't want a market cap weight. Maybe we want to equal weight between the stocks or tilt it in some other way.
Yeah, there's a lot of interest in tilting away from the US. For example, you can just split it into 3 regions very cheaply. You'd have developed ex-US, which would make up about 25% of your portfolio, 65% would be US, and 10% would be emerging markets. And then if you wanted to tilt away from the US, you just dial down the US and push up the other 2 in proportion with each other.
So slightly less simple than your one fund portfolio, but you can see why people are tempted to do it.
I can certainly see it. I don't think I do it myself. I just know that when I try to do this stuff, it always goes wrong. I don't know why, but it always goes wrong. Something happens.
I've always said pure alpha in shorting your decisions.
But only the fund portfolio, right?
But this year so far, we're only a third of the way through, but it would have made sense so far.
Yeah, and you would have made a lot of money actually shorting my fund portfolio.
Oh, I mean tilting away from the US.
Oh, yeah, that would have worked as well, yeah. But really, it's a question about whether it'll work in the future. Okay, we're going through a weird period right now, but once the immune reaction of sanity starts to kick in, I think that many of these dislocations in markets will start to fade.
So you're just ignoring the high concentration we've seen recently and are saying it'll resolve itself. I don't think I can second guess it. Let the market sort it out for me.
And the thing to remember is that the US is less concentrated than many other markets globally. Compare it with almost any other country index, and it is not particularly concentrated. It's concentrated a lot for the US compared to its own history, but not relative to other markets.
I guess if you knew for sure that those mega caps, the Microsofts, Apples, Nvidias of the world, were going to struggle over the next 5 years and see their relative weights in the index shrink, if you knew that for sure, you'd do something about it, right? You wouldn't market cap weight, but we don't know that for sure.
If anything, I'd say that those companies are particularly well suited to weathering the storm. If you think about Microsoft, for example, are they going to have a huge tax imposed on them by foreign countries? Maybe. Maybe Europe would choose to do that, but it would also be a bit of an own goal because so many companies rely on Microsoft for their software. So if anything, I think it's going to be the smaller companies which are going to really suffer through this because they haven't got such strong balance sheets, such diversified sources of revenue. So if anything, this is creating a case for the Magnificent Seven, I'd say.
But what if you don't think that? What if you're in the position where you think we are going to be in for some really tough times economically? This political storm is going to last for at least another 4 years. Maybe we'll see a recession. But you're not that confident in it. You don't want to move away from equity completely, like a little scaredy cat. What would you do then? What could you do?
Well, the tilts which have worked well so far in terms of not losing as much are things like value, high dividend yield, quality, low volatility. All of those have done pretty well in terms of not selling off as much. They're down by around 10%, low volatility by 2%. Whereas if you compare that with, say, small cap growth, that's down 20%. Anything small cap down by about 20, growth by about 18.
If you're going for low volatility funds, though, you're kind of just taking the chicken out of the chicken salad. We're just left with leaves, Romin.
Yeah. What you've got effectively is a bond, but just with more volatility.
Well, you mentioned bonds. Let's talk about bonds. If you're not 100% equity in your core, like a lot of people aren't, and I'm not saying they should be, if you're choosing a bond fund right now, what are you looking at?
Well, I'd probably go for shorter duration because the bonds which are sold off the most are the ones with mid-duration or particularly long duration. Now, usually the US is seen as a safe haven, and its bonds are seen as a safe haven. Not so right now. They're selling off along with treasuries. It happened again yesterday. So that was the 21st of April after we came back from Easter. After the Americans came back from Easter, we hadn't yet.
I saw in the FT this morning a story about how in the recent panic, Japanese investors sold $20 billion of foreign bonds, largely treasuries.
And you can see why. They're being hit by tariffs. The US policy on trade seems completely out of control, so volatile it changes day to day. It just doesn't feel as if the US is safe. It's not. It's completely changed its character, and as investors, you have to price that in. And that's true particularly for bonds, which are supposed to be safe. Because remember that for the Japanese investor, there's the currency risk overlaid. Even if you have a currency hedge overlay, eventually the volatility will feed into the pricing of that derivative.
It feels like the bond market's in a weird place, right? Because a lot of people expect a recession, which typically you would think would suppress yields and cause bond prices to rise. But there's this risk of stagflation, particularly in the US, where tariffs may cause inflation to return. At the same time as you get an economic downturn, the Fed doesn't know what to do, and bond markets will not like that.
No, that's exactly right. And I think that's part of the worry. Kryptonite for bonds is inflation. And if we do get anchored inflation, that's even worse. Of course, there's going to be a 1-year effect of higher prices through tariffs. But of course, if people anchor on that, then it starts to become sticky. Now, that's what the Fed is really worried about. If you hear Jerome Powell talking about this, justifiably, I think.
If you were going to buy a bond fund, would you not just ignore the US, buy a European bond fund right now? Or is that, again, trying to predict things that you don't really know much about?
Well, personally, I'd always go for gilts because I don't think there's much point in diversification when it comes to the government bond market. I'm quite happy to stick with gilts, hold them to maturity, and I don't really care about volatility. Or I'd go for really short duration where there's not going to be a sell-off and you don't really care about yield curves flopping about in response to crazy policies.
You're not tempted by linkers offering a real yield of, well, I think almost 2.5% over the long term?
Well, I've been sucked into that black hole previously, and it wasn't pleasant, I've got to say. I came out badly radiation burnt. But look, with inflation-linked bonds, as I learned myself, it's always about the break-evens. What's priced into the inflation-linked bond? Because what you've always got to think is inflation going to exceed the break-even rate baked into this bond over the life of the bond? And current break-evens, if we just look across the curve, is pretty flat actually. The 5 years about 3.3%, 10 years about 3.2%, and 20 about 3.2%. So really, you've got to think, is inflation going to be 1 percentage point or more above the Bank of England's rate for the next 5-10 years?
But that is RPI inflation that they're linked to. They don't target 2% RPI, Roman.
Well, it's RPI now. They might switch to CPI. That's a shocking thing.
Yeah, I'm not going to gamble on inflation-linked gilts. But if I did have a situation where I didn't need the money for 30 years and I was being super cautious, a real yield of 2.5% doesn't look too bad right now.
Yeah, I don't know. I just think there are better places for capital. I think eventually these things are going to go away. And if it's new money, then you're buying at a discount. So if anything, I'd say this is making a really strong case for equity. Plus, there are all these really good bargains. You know, all these things which I wanted to buy, which I did buy, some of them, are now available at cheaper prices.
Well, let's talk about that after the break then. Time for the fun portfolio.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple? You can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 0.5% cash back on all transactions up to £20 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk, and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Okay, Roman, so we know by now that you like to reframe a crash. You like to think of it as a bargain, where assets are on sale rather than a reason to panic. And for this reason, you have your famed market crash shopping list. Has anything got so cheap that you've pushed the button?
Not yet. I'm watching very carefully, and I'm quietly salivating at these prospects. But look, I have got lots of cash in the sidelines ready for this. I've been waiting for a long time. So this is a very exciting moment for me.
All right, what are you watching most closely?
Well, I think a popular theme this year has been European defence stocks. Obviously, we've seen the invasion of Ukraine, and European countries are spending more on GDP to defend themselves. Now, that's not something that's going to change anytime soon, I don't think. Plus, we've seen the US step back from its support of NATO. Of course, it's still a NATO member, but some of the things which Trump has been saying are quite alarming and have backed up that choice to spend more on defence.
Roman, this is so funny to me that we're starting talking about the market crash shopping list, and you're talking about the one thing which has not crashed. Like, Rheinmetall is up 175% over the last year.
But it has come down compared to where it was.
Not really.
So there is a European defence ETF from WisdomTree. The ticker's WDEP. So you can use that to track what's going on in this kind of defence space in Europe. And you're right, it hasn't crashed a lot. At least it crashed very briefly. And this was on the 4th of April. And then it very quickly rebounded. But I think that may happen again. But what it actually means is that as people are scared about US equity, that usually drags down other stocks. And it's certainly happened in April, and I suspect it'll happen again. So that means you're going to have another bite of the cherry. And that'll be a theme for this year, I think, which is even really good themes, good stocks, good bonds, effectively are going to go on sale.
Yeah, I agree with that. I guess the thing is with European defence stocks is that right now that looks very much like a momentum trade to me. I don't know how much is based on fundamentals and how much is just based on this narrative. Maybe the correct narrative that a lot of money is going to be thrown at this sector. But right now it is still a narrative, I would say.
But look, with a thematic basket, it's always a narrative. And if you're late to the party, normally you have to pay very high valuations. But what will happen is if we do get a big equity sell-off, these things will be dragged down too. So not such a big sell-off, but that itself tells a story.
Okay, but what are you watching that has actually sold off?
Well, a stock which I love, a fund which I love, is Scottish Mortgage. And that's part of a theme which is disruptive growth type stocks. Now, I bought Scottish Mortgage when it was cheap after its big crash in 2022. It went up a lot. Now it's come down a lot. So I think if you are into that kind of techie, nerdy type investment, which buys unlisted stocks like SpaceX, then yes, Scottish Mortgage is cheap again. And if we broaden that idea, if you look at the Magnificent Seven and growth as a style of investing, that actually correlates very highly with quality at the moment. Because if you think about the aspects of quality, low leverage, high return on equity, good earnings growth, well, guess what scores well on that? Yep, it's the Magnificent Seven. Now, that may not always be true. I suspect what will happen in future is that something else will become quality. But as a style of investing, I love this factor. And it's become cheap because we've had the big sell-off. So Scottish Mortgage, quality, growth, if you like that style of investing, tech stocks, if you like that style of investing. Look at how much Nvidia and Tesla have fallen over the course of the last few months. All of those have become much cheaper than they were. Are they cheap in absolute terms? Probably not. It's still the case that there's quite a lot of euphoria baked into the valuations there.
You know, the one I'm watching really closely is Alphabet, or Google, if you like. That's the one I'm really looking at. So the price, like the stock price, is now where it was in October 2021. And if you look at the forward price to earnings ratio, other than a very brief week in 2022, it's the lowest it's been since 2013. So the forward price to earnings ratio for Alphabet is 16 times right now. Remember, in 2021, it got up to 34 times. That's a huge crash down to earth for Google, at least in terms of the multiple people are willing to pay for the stock. Now, there are reasons for that. There's huge antitrust action going on against Google. There's a big case in the US from the Department of Justice at the moment, which Google has kind of lost. And the question is, what is the remedy going to be? What are they going to be forced to sell? What businesses are they going to have to exit? How's it going to impact their AI activities? And how big will the effect be on earnings, which, remember, largely come from its search engine still. But despite all of that, and there's regulatory action in Europe, there are some things which I quite like about it. The first being, I'm well into AI at the moment, and their new model is by far the best I've used. This Gemini 2.5 experimental model, incredible, right? The deep research function, I plugged in like tell me everything about return stacking in the UK. And it built this 50-page report, which was better than anything I've read on the subject. It was incredible. It literally went away for 15 minutes and thought about it and then came back with this thing, which was amazing. And on top of that, their robo-taxi business is actually starting to scale. Waymo's starting to do pretty well. And I think YouTube has a lot of untapped value. If we're moving to a world where video content becomes really cheap to create, we were already in that world, but now with AI and artificially generated video, I could see a huge amount of value in YouTube. The question is AI and all this stuff going to cannibalize its search business faster than it can build a new world? But I don't know, maybe there's value in Google. What do you think?
Yeah, I haven't used Google for some time. I've been using Perplexity. Maybe I should go back to it and try out this Gemini model. But how are they going to scale that? How are they going to price it? Those are the kind of things that worry me. And I have to say from personal experience, YouTube videos might be cheap to create, but they're not easy to create.
Well, this is why AI is going to solve your problem, Romin. Virtual Romin. Infinite content. And Google's just going to cream a little bit off the top.
Yeah, don't joke. I've been seriously thinking about it.
I don't know. We don't do single stock recommendations, and nothing in this podcast is a recommendation. It's just something I'm looking at. I'm looking at Alphabet right now thinking, is it going to be this cheap for very long? Of note, their quarterly earnings are due later this week. To see what their guidance is like.
But it's not true that all of the Magnificent Seven are cheap right now. If you look at Tesla, for example, its forward PE is still 84 times. So that's a real outlier. People are still betting on it doing what Waymo's already doing, which is creating this taxi service. So I'd say there's a lot of euphoria still in equity, and that worries me. So certainly pay attention to valuations if you are going to try and find bargains. Because at least for equity, that's built in because you've got those forecast earnings, you've got the trailing earnings, and if the valuation's there, you should use it. Don't just look at how much the price has fallen.
I mean, some people say that in a downturn, that's a stock picker's market. They're going to find the bargains. Now, I don't think either of us necessarily agree with that. There's not much evidence that active managers outperform in any environment, really. But if you were going to back one active manager, so to speak, maybe this could be Warren Buffett's last hurrah. He's built up this huge cash pile. Prices are getting cheaper. Is now not the time for Berkshire Hathaway? The stock's up 12% this year, despite all the troubles.
Yeah, and his style of investing, probably, it's hard to characterize, but maybe it's value, and value's done pretty well. But if you cast your mind back to 2008, when he bought those Goldman call options, well, look, that was incredible timing. So yeah, in a crisis, he's a guy with cash. He's a guy who understands valuation, who understands Mr. Market's moods. So I think, yeah, he'll probably be well suited to have a last hurrah.
He's been patient, hasn't he, building up this cash buffer? Just hoping he got one more market crash in him. Maybe he's going to get it. Let's see. Anyway, let's move away from equity for a moment. Is there anything on your market crash shopping list in terms of other assets?
Yeah, for example, if you look at commodities, they've certainly come down a lot. So copper's down very sharply. Oil also down very sharply. And as always with these investments, you think, well, is this going to recover? Is there an underlying theme which is going to push the price back up? Now, of course, we're moving to renewable energy, so the demand for fossil fuels is going to weaken over time. But the point is that the twilight is going to last a very long time. And that means that demand for oil is not going to go away. So if you do believe that oil's interesting longer term, then a price of $60 a barrel might be something of a bargain. And you can get exposure various ways. There are ETCs, exchange traded commodities, which give you direct exposure. They're complex with commodities because you have a futures curve and you have roll costs. So just make sure you understand that before you buy those. Or you can go for mining companies or oil production companies, either upstream or downstream, in order to get exposure. So there are various ways of doing it. I bought a copper miner portfolio just before all of this kicked off. So unfortunately, I've had to ride it out. But I think I might put more into that. And I think the long-term case for copper, which is the energy transition, is still very much in place. Maybe not for the US, but for the rest of the world.
Yeah, it's not something I would bet on necessarily, commodities. But I would consider it as part of my portfolio. People talk about it as a hedge, don't they? Especially as an inflation hedge. And a lot of these off-the-shelf portfolios might include, 10% in a broad commodity fund. If you've been thinking about building up those kind of hedges, maybe it's cheaper now to do it.
But these are very volatile investments, and that's another thing to bear in mind with commodities. Be prepared for a very, very rough ride. They're also unpredictable because they're affected by things like geopolitics, particularly oil, which is often affected by things in the Middle East.
Yeah, to me, they only make sense as a hedge, a small hedge in a much bigger portfolio. Is there a case to be made for other hedges right now, especially if you're nervous? I noticed that the rougher total return fund has finally started to return something.
Yeah, thank goodness for that, because people were talking about how awful its performance has been. Historically, it's done pretty well during good times as well. So we actually interviewed two of the fund managers from Ruffer, Duncan McInnes and Jasmine Yeo. But the idea behind Ruffer is that it invests in things which people panic into, but it also has some exposure to the upside. Now, that sounds like the Holy Grail, something which doesn't lose value during good times, which gives you a little bit of upside exposure, but which potentially can cushion your losses on the downside. What it depends on is their ability to buy what people will panic into. And unfortunately, they went for a credit bet, which didn't pay off. Now it is paying off. Historically, they've bought lots of sometimes odd investments. For example, they bought Bitcoin at exactly the right time a while back.
A very, very small amount of Bitcoin.
A very small amount.
That would kind of be atypical as an investment for the fund.
Yeah, it was weird. It was a 2.5% allocation, so it was very small, but it caused a lot of discussion. But it makes the point about how they invest. But 2.5% of the fund was £1 billion, so that's what made people pay attention.
Well, let's have a look what Ruffer's total return fund is invested in right now. So 48.8% is short-dated nominal bonds. 9.4% is cash. So if you add up those two things, you're looking at almost 60% in cash and cash-like investments. You got almost 10% in gold and precious metals, 5% in long-dated inflation-linked gilts, around 5% in financial equities, and a little bit in consumer discretionary and consumer staples and energy. Defensive, as you'd expect.
But really what you're betting on is that they choose the right things, the safe things. So if you are worried about further volatility, that could be something to look at, or funds like that, which are supposedly defensive.
These are kind of like tail risk funds, aren't they? There's a lot of them out there.
Yeah, and when I did a historic analysis, I did this as an explainer for our community. It turned out that Ruffer was one of the better ones historically. But look, the fund managers change, the people who run the funds change, so you can't always rely on historic performance to predict what's going to happen in future. Particularly when it comes to tail hedges, which are always different. There are no two crises which are the same.
And it's always fun to run in and panic and buy a tail hedge in the middle of a crisis. But there are other options, aren't there, if you did want to look at tail hedges? So one that hasn't performed well this year, but might do going forward, is managed futures or trend following, which can go long or short across different asset classes and is designed to help you ride out bad periods and complement your core equity holding.
There isn't a wide choice in the UK. The fund management fees are usually high, and you depend on the fund manager choosing the right assets to go long or short, because they have complete discretion whether they buy something long or short in the futures market, and it's really easy to switch. But it's not easy to get the direction right. So while markets are trending, yeah, it works perfectly. Whether they're trending up or down, these things can make use of that trend.
There is one UCITS trend fund I've noticed, which is the Winton Trend Fund, which has been around for quite a long time. And in 2022, in that crash, it did extraordinarily well. But this year, in 2025 so far, it's not done that well. It's down almost 4% in sterling terms. But what a lot of people say about these trend funds is that if you're going into a crisis, they often don't do that well right at the start. But then if the crisis persists, then they become a valuable part of your portfolio.
But if you're thinking about hedges, you've got various options. We've got those tail risk funds. We've got commodity funds. There's always the choice of de-risking into short-term money market funds. But the real star of the show this year has been gold, which has just done incredibly well. Because when people are scared, they often buy gold, and people are very scared at the moment. And that's not just true of the US, it's true in Asia. There's been very broad-based buying of gold.
If you go into it now, you'll be buying at what looks like very high prices. But then gold can go as high as it wants, right? There's no real fundamentals.
Well, you can compare it to the value of the US dollar and interest rates. And by that measure, it's very expensive indeed. So once that fear risk premium starts to fade, I think there could be a fair old correction for gold in the future. But of course, we're not there yet. The source of volatility is still sitting in the White House.
Surrounded by a load of gold, if you look at the pictures. So I think we've covered a lot of things to be looking at for the fund portfolio. Any last assets you want to flag?
Yeah, the one that's always on my market crash shopping list, because it's a fairly regular source of crisis and it becomes very cheap and very yieldy when that happens. And that's junk bonds. Now, just to explain what they are, these are bonds issued by companies with low credit quality. So they pay a high coupon because they may default and they have to compensate you for buying their junk. Now, the actual spread you earn, which is the additional income, varies over time. When there's a crisis and it's pricing in a very high probability of recession and defaults, the credit spread widens. And until recently, the credit spread was just ridiculously tight. It was as if nothing was ever going to go wrong. Well, everything does seem to be going wrong, so the credit spread has widened. I think it's probably got further to go, but now we're in this wonderful position where we've got higher risk-free rates. Layered on top of that, like icing on a cake, we've got a wider credit spread. So if you look at funds like the PIMCO Short-Term High Yield Corporate Bond Index, STHS, the current yield to maturity for that is 8.4%. So that's the last 12 months dividends divided by the price as we record this podcast.
Presumably, if you buy that, the danger is that things get worse, the spread gets wider, and the value of your fund falls.
Exactly. It is risky. And during these periods of crisis, then things do get worse. So you've just got to be prepared for that. But the way I think of it is, will the entire high yield market default? And the answer is no. There will be higher losses due to higher default rates, but we haven't started to see those yet. So maybe the thing to do is just to watch that yield. When it's distressed, it blows out as far as 10%, sometimes even higher. So just keep your eye on those spreads and just think about whether you're comfortable with that kind of risk, because it could go much lower. In 2009, HYG, for example, which is a US high-yield bond fund, fell by about 40%.
So talking about junk bonds with issuers that might default, let's talk about gilts. So I'm joking, of course.
I hope you're joking.
The British government would never stiff us like that. So if you're going to buy a gilt in your ISA, would you agree with me, Romin, that it makes sense to go for a high coupon gilt? Usually we talk about the low coupon ones because you can buy it outside of a tax shelter and benefit from the fact you don't pay capital gains tax on it. But if you're in an ISA, who cares about capital gains tax? Let's go for the high coupon gilts because they often sit above the yield curve. Like you get more yield than you might deserve because everyone else is buying the low coupon ones.
Yeah, that's an interesting one. And it isn't a small effect. If you plot the UK yield curve, and you can see it on our gilt tracker, it's amazing. All of the small circles, which are the ones which aren't tax efficient, are above the line. And a lot of the very fat circles, which are the ones which have a low coupon and which are very tax efficient, are well below the line. So yeah, why not monetize that? If you're going to be buying these things inside an ISA or a SIP, just go for yield. So for example, if you look at T31, now that's the ticker for one of the UK gilts. It's got a big fat coupon, 4%, so it's very unattractive to people who are buying it outside an ISA or a SIP. Most of its return comes from income, not from capital gain. That matures on October the 22nd, 2031.
So 6.5 years from now, and you could lock in a rate for that time. What rate are we locking in? Remember, it's not the coupon.
No, it's the overall yield, which includes the capital gain or loss. In this case, it's 4.2%. So you're getting a tiny bit of capital gain, but mostly it's to do with income. Now that one's sitting quite a long way above the curve. These are bonds, so we're not talking about a huge gain pickup, but it's certainly better than a lot of other gilts. And there's a whole bunch of these: TY25, T25, T27A, TS27, T28, and so on. All of these are getting a fat yield because nobody loves them.
Now, I'm not saying you should spend your ISA allowance on a gilt. That's going for a particularly dry, boring salad. But, there are reasons why you might want to buy a gilt. And right now, you could lock in a yield of 4.2% or above for 6.5 years. For people building gilt ladders, if you're doing it in a tax shelter, you do get a little bit of extra juice for it.
But look, you can probably tell that we're quite excited about all of these options which are now becoming available. But as always, bear in mind that this is not financial advice. All of this stuff is really just about discussion. And in this kind of market, nobody knows what's going to happen. And so it could be that these things which seem cheap now are going to look a lot cheaper later on. Now, we mentioned the yield curve, and one of the things which is available to our members is a yield curve graph, which updates daily, so you can see those gilts above and below the curve, plus lots of other goodies, almost 300 member explainer videos. And to learn more about becoming a member, just go to our website, pensioncraft.com/membership.
Okay, today's dumb question of the week is, what's the point of a fund portfolio if it's not going to beat the market?
Well, from bitter experience, Michael, I have to say that it's still fun, even though I've regularly lost money. I have these great ideas, like a copper portfolio. That was a great theme, but then I got trumped.
Yeah, but you're not wrong, Roman. You're just early. This is early days.
I'm a long-term investor. That's what people always say. But I think copper eventually is going to recover. And all this means is that I can put more into that portfolio at a cheaper price. And these things are paying out a dividend, so I'm making some money along the way. Because I went for the copper miners for that very reason.
Yeah, sure. No, I get all the logic for what's in your fund portfolio, but my question is, why have a fund portfolio? Like, we believe, right? I think it's one of our core beliefs that you can't reliably beat the market. And probably no one can, or very, very few people can. And we don't believe we can. So why would we even have a fund portfolio? Why not just have everything market cap weighted in stocks and whatever other assets you want to hold?
Well, I think you said it at the beginning of the podcast, which is that it's boring. I think it's good to have some fun. And I feel really engaged with markets, and I have a good time working out what I'm going to buy next. And sometimes it does work and it feels really good.
Yeah.
But then often it doesn't, and then I feel like an idiot. But it's good because it reminds me that if I were to try this with my core, it'll go wrong. So from that point of view, it's almost like a memento mori. It tells me that, remember, you're not a fund manager, Roman. And even if you were, you couldn't beat the market.
And I think, as we've said before, it's a little sandbox, right? You limit how much your fund portfolio is as a percentage of your overall assets. And mucking around in there, yeah, you might lose a bit of money. But the bigger thing is it's going to stop you messing around with the majority of your portfolio.
And I've learned so much. I've been playing around with all sorts of toxic things, and it's taught me that, no, they're not good. And FOMO eventually is going to hurt you. So from that point of view, it's been good. But I've also had some things which did work. And from that point of view as well, it's been useful.
But how much fun is too much fun, Roman? How big is the sandbox?
Well, for me, 10%, that's my kind of limit, because it's big enough to hurt if it goes wrong. And it means that you've actually got some skin in the game, and that keeps it interesting. But it's not large enough that I won't be able to retire if I ever choose to retire, which it certainly doesn't feel like I want to.
You've at least got to wait till copper rebounds before you can retire, Roman.
That's right.
I mean, I guess the upside of your fund portfolio, Roman, is that it does create a lot of content for you. Imagine if you only had an index fund.
Yeah, it's so funny. I do see these accounts on YouTube where they talk about their Vanguard holdings, and you just think, why would anyone watch that? It's like describing washing up. It's just not interesting at all. But I've got to say, I've been having a lot of fun over the last quarter.
In your sandbox.
Yeah.
It's funny, my wife's always super paranoid about letting our daughters play in a sandbox because apparently cats go to the toilet in them. And that is not good, which I think is the perfect metaphor for the fund portfolio. Thank you for joining us for many happy returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.